Today I'm going back to the basics. I'm going to explain all the key tax concepts for beginners that you're going to want to know, such as how does the tax system work? How are taxes calculated? What are deductions? How do you take them? How do you make sure you're doing the write-offs the correct way? So if you're a tax beginner, this is the video for you. Make sure you stay all the way to the end of this video. I'll also be answering tax questions from some of my subscribers that you're not going to want to miss. Without further ado, let's dive in. Okay, first things first, let's discuss how the US tax system works. Taxes are payments that the government requires its citizens to make in order to fund its operation. You see, the government's a business, and taxes help to pay for services that the government provides, such as the military, infrastructure management, public education, Social Security, Medicare, and much more. There are many different types of taxes that are collected to help pay for these things. There are income taxes, which are taxes on the income that you generate. You're probably familiar with this, but there's also sales taxes, which are taxes on the purchases that you make. And there are property taxes, which are taxes on the property that you own and more. For most people, income taxes are going to be the most significant of the taxes because that's the highest amount that we typically pay. There are different kinds of income taxes. For example, there are federal income taxes, which are income taxes levied by the federal government, and there are state income taxes, which are income taxes levied by the state, and there's also local taxes, which are income taxes levied by local governments, such as towns or cities. Federal income taxes apply to people living in all states in the union. However, not all states and not all local governments charge income taxes. So your overall tax burden will depend heavily on where you live and on where you operate a business. All right, let's keep moving. How are income taxes calculated? In the United States, we have what is called a progressive tax system. What this means is that there are tax brackets, and as your income rises from bracket to bracket, it is taxed at higher rates. So the more money you make, the higher the rates will be that your income is subject to. To understand this concept, let's take a look at an example. Let's say that in 2024, you had $100,000 of taxable income as a single filer. In this case, the first $11,600 would be taxed at a rate of 10%. The next $35,549 of income would be taxed at a rate of 12%. And the remaining $52,850 would be taxed at a rate of 22%. This is because that's just how the tax brackets were arranged in 2024. If you want to see how the tax brackets are arranged in 2025, check out this video here. Now, a progressive tax system is an alternative to having a flat tax rate, such as 15%, that would be applied to everyone. So in order to calculate your income tax burden, you would need to see what your income is, and you have to take a look at the tax brackets that will affect you. You need this for federal, state, and local taxes. If you live in an income tax-free state such as Texas, Nevada, or Florida, then congratulations. You won't owe any state taxes. However, for most of you watching this video, you can expect to pay state income taxes in addition to federal taxes. But keep in mind that there are things called deductions that can actually reduce your taxable income. And if your taxable income is reduced, then it can dramatically reduce the amount of taxes that you will owe. So, what are tax deductions? Now that you know the basic understanding of what taxes are and how the tax system works and how they're calculated, we need to talk about the deductions. Deductions are the amount of money that the government allows you to reduce your taxable income by. So in other words, there are specific expenses that the government allows you to subtract from your total income, which thus, in turn, reduces the amount of taxes that you would have to pay. So to illustrate this, let's say you made that same $100,000 and you qualified for $30,000 in deductions. In this case, you would subtract that $30,000 from your taxable income. This would result in you only owing taxes on the $70,000. Big difference, right? Deductions are very important because they can dramatically reduce the amount of money that you would have to take out of your bank account and pay to Uncle Sam. Therefore, we want to get as many of those deductions as possible in order to reduce our taxable income to the maximum extent within reason. Tax strategists such as myself help to maximize your tax deductions for the right reasons. Through tax strategy, some people are able to reduce their tax burdens by all the way to zero. You can watch many of my videos discussing this. Perhaps the most important of all the deductions is the standard deduction. The standard deduction is a fixed dollar amount that reduces the income on which you're taxed, and it's available to taxpayers who do not itemize their deductions. Itemizing your deductions means you have a list of eligible deductions that qualify, such as medical expenses and state and local taxes. But for some people, claiming the standard deduction results in a larger overall decrease in taxable income, and for others, Itemizing deductions leads to a larger overall decrease in taxable income. You should speak to a tax professional, if possible, to see which one is better for you. Claiming the standard deduction is definitely the simpler method because you don't have to list all your individual deductions. You just have to indicate that you would be using the standard deduction. The standard deduction amount are also usually quite significant, and they are adjusted for inflation every year. For 2024, the standard deduction amount was $29,200 for married couples, and if you were single, it was $14,600. If you were head of household, it was $21,900. Now, let's talk about tax credits. Tax credits are similar to tax deductions in that they can have a significant impact on the amount of taxes that you have to pay. And just like tax deductions, tax credits can reduce your overall tax burden. However, unlike tax deductions, which reduce your taxable income, tax credits directly reduces your tax liability. So let's say you owe $25,000 in taxes and you have a $3,000 credit. You're going to only owe $22,000 in taxes. As you can see, tax credits can be quite helpful when it comes to reducing your tax burden. There are many different tax credits you can potentially qualify for. Some of the most common tax credits are the Earned Income Tax Credit, the American Opportunity Tax Credit, the Lifetime Learning Credit, and the Child Care Tax Credit. Now, I'm not going to do a deep dive on all of these credits in this video, but you can use these popular tax credits as a starting point for your research if you want to take advantage of tax credits. Another important thing to know about tax credits is that there's two different kinds, refundable and non-refundable. A refundable tax credit is one that the government will actually give you a refund for if it drops your tax liability below zero. So for example, if your tax burden is $1,000 and you qualify for a refundable credit of $2,000, the government will give you a refund of $1,000, which would be the amount that was below the $0 of tax burden. A non-refundable tax credit, on the other hand, is one in which the government will not give you a refund if your taxable income drops below zero. Make sense? All right, let's keep going. Business versus personal taxes. If you're an employee, then you will only need to worry about paying personal income taxes. However, if you're a business, you will need to understand what business taxes are. Business taxes are taxes that your business is required to pay to the government, and business income taxes are levied on business income. The type of business entity that you have will determine whether or not your business will be required to pay business income taxes or whether the business will pass through its tax and income to you personally. Pass-through entities such as LLCs and sole proprietorships and S corps don't pay taxes. They have pass-through income, which means the income passes to you personally. Then you pay personal taxes on this income. However, if you own a business such as a C corp that is not a pass-through entity, then your business will owe taxes on its income and you will still owe personal income taxes. Many business owners choose to go with pass-through entities to avoid this double taxation. All right, now let's talk about how to actually file your taxes. To file your taxes, you're going to have to complete what is called a tax return. Tax return is a document that you will fill out with the IRS. This form reports all of your income, deductions, credits, and other key tax information to the IRS. Now, in order to complete this form, you need a variety of different tax forms, such as a W-2, which reports the income that the employees earned during the year. If you're an employee, your employer will provide you with this form. People who are not employees need different forms. For example, if you're a freelancer, you'll file a 1099 form, which reports your earnings for freelancing. If you have a partner in a partnership, you would need a K-1 form that reports your income from partnerships. So you will need to collect all of the relevant tax documents and use the information on them to fill out your tax return correctly. There are various software programs that can help you to fill and file your tax return. TurboTax, H&R Block, you name it, are some of the most popular ones that some people utilize. Tax professionals can also help you, and we have different software. And once your tax return is filled out, the final step is to file it with the IRS and your state government. Okay. Those are the basics that I would like you to know as a beginner. Now, as promised, here's a quick question from one of my subscribers. The question was asked by a user, the Party Thieves. The question was, my wife and I own a business. We are thinking about doing an LLC, but should we wait till the end of the year for tax purposes or do LLC immediately? If you're thinking about forming a business, you can choose to wait depending on the state that you're in to avoid the state filing fees. If you wait past December 17th in the state of California, for example, normally they don't require the $800 state filing fee in that first year of setting up your business. They'll treat the business as being kind of set up in January 1st to avoid that state filing fee. But if you need to get your business set up in order to take your deductions and expenses absolutely form that LLC. It's time to get operational. If you need any help, you can click on the link below to set up an LLC, or if you need help with your tax strategy, be sure to schedule a call with my team. My name is Karlton Dennis. Thank you so much for watching this video. You know what to do. Like, comment, subscribe. I'll see you on the next one. Cheers.